So can you really invest in real estate with just 5 grand? Well, this explainer, brought to you by Real Estate Rank IQ, is going to show you exactly how. Let's just jump right into the numbers. Yeah, I know. Right off the bat, you're hit with this massive number. The median US listing price is almost $430,000. I mean, it's a super intimidating number, right? It makes most people just think, nope, real estate is completely out of my league. So that leads to the $1 million or, well, the $5,000 question. With a barrier to entry that high, is 5 grand even enough to get your foot in the door? Can you actually get in the game? Okay, so the short answer, it's a huge, resounding yes. And look, we're not just gonna tell you it's possible. We're gonna break down exactly how you can do it. So here's what we've got on tap. We'll start with why $5,000 is a great starting line. Then we'll cover the passive routes, like REITs and funds, and the more active ones, like notes and deals. After that, we'll compare all 7 of these routes side by side, and we'll wrap it all up with a 90-day action plan you can literally start tomorrow. All right, first up, the $5,000 starting line. We're talking about why even small amounts of money can really work in today's market. You know, there are really 3 huge shifts that have made all this possible. First, fractional access is pretty much standard now. I mean, you can buy tiny pieces of massive real estate portfolios for like $1. It's crazy. Second, crowdfunding platforms have totally lowered the bar. Some of them will let you in for as little as $10. And finally, with automated reinvestment, those small dollars can compound like crazy and turn into some serious exposure over time. Okay, let's move on to the next section and see how all this plays out. We're gonna look at the passive paths first. These are the awesome, hands-off ways to get into real estate without having to be a landlord. First on the list is REITs. Now, a REIT, which stands for Real Estate Investment Trust, is really just a company that owns, operates, or finances real estate that generates income. So when you buy a share, you're basically buying a small slice of that company and all the properties it owns. And the options here are pretty amazing. You can go super broad with ETFs like VNQ for instant diversification, which is a great starting point. Or you can get really specific and target sectors like industrial real estate with a company like Prologis, data centers with Equinix, or you could even get a monthly dividend check from a retail REIT like Realty Income. So many choices. So what does this actually look like with your 5 grand? Well, let's say you put $3,000 into a broad ETF. You might see about $120 in yearly dividends. Then maybe you add $1,000 to a specialty REIT for another $30, and $1,000 to one of those monthly payers for, say, $55. All told, that's around $200 in cash coming back to you in the first year. Not bad, right? All right, our second passive path is crowdfunding funds. This is where your money gets pooled with a bunch of other investors to buy into portfolios of private real estate, and it's all managed by pros. So again, it's another fantastic hands-off way to do this. And you've probably heard of some of the big names in this space. We're talking about platforms like Fundrise, Realty Mogul, they have their Mogul REITs, Diversifund, Straightwise, and Yield Street. They all offer different strategies. And a lot of them are open to regular, non-accredited investors, which is key. So here's a cool way you could build a balanced strategy with your 5 grand. You could split it right down the middle. Put half into an income-focused fund that's aiming for cash distributions. In this example, that's about $175 in your pocket. And then you put the other half into a growth-focused fund. There, you'd see a potential gain of maybe $150 on paper as the property values go up. So you get a mix of cash now and growth for later. Okay, the third passive path is fractional ownership of actual rental properties. This is pretty cool. You buy an equity slice of a specific house, and then you get a cut of the rental income and any appreciation when that house is eventually sold. And you do all this without any of the landlord headaches. No calls about leaky faucets. And the big player here is a company called Arrived. They're known for these incredibly low minimums. We're talking around $100 a property. So this lets you take your $5,000 and spread it out across dozens of different homes in totally different markets. It's a great way to diversify. All right, let's switch gears completely and talk about the active paths. Now, these routes, they definitely require more of your time and effort, but they also come with completely different risk and reward profiles. So path number 4 is investing in short-term real estate notes. Essentially, you become the bank here. You're funding these short-term loans for fix and flip projects, and then you just sit back and collect interest payments as your return. Pretty straightforward. And the potential cash flow here can be really solid. If you built a diversified $5,000 portfolio of these notes and you were netting a 10% annualized return, well, that could generate around $500 in interest in your very first year. That's a significant return on $5,000. Next up is a classic, and I mean classic active strategy, house hacking. This is where you buy a small multifamily property, like a duplex or a triplex. You live in one of the units, and then your tenant's rent pays down your mortgage. You are literally turning your biggest liability, your housing cost, into an asset that makes you money. Okay, so how on earth could this work with only $5,000? I know, it sounds crazy, but the key is you have to stack all the advantages you can find. You need to get a low down payment loan, like an FHA or a VA loan. You'd have to target lower cost duplexes. You'd need to negotiate for the seller to cover your closing costs. And most importantly, you'd have to find some kind of down payment assistance from a state or local program. Look, it's definitely a challenging path, for sure, but it is possible. Okay, our final two paths, tax liens and wholesaling, are by far the most hands-on. With tax liens, you're basically buying property debt at auctions. And with wholesaling, you're the deal finder. You put properties under contract, and then you sell that contract to another investor for a fee. Honestly, both of these are pretty much full-on businesses in themselves. Whew, that was a lot of information, I know. So let's move on and put all 7 of these routes on one screen. This should really help you figure out the right fit for you and your goals. Okay, let's break down the trade-offs. You can see on one side, you've got things like REITs. They offer high liquidity, meaning you can get your money out easily, but the returns are a bit more modest. On the complete other side, you've got wholesaling. It's super high effort, a real business, but the potential returns are huge. And then right in the middle, you have these interesting options like crowdfunding and short-term notes. They can offer really compelling cash returns for pretty low effort, but, and this is the catch, you sacrifice the ability to sell quickly. So your choice here depends entirely on what you're trying to optimize for. Is it convenience, cash flow, or are you swinging for the fences and looking for a big payday? All right, now for what I think is the most important part, turning all of this knowledge into action. So here is your 90-day plan, a simple, straightforward playbook to get you started. Here's what a really balanced approach could look like for your first $5,000. You could put $2,000 into a core REIT ETF for that liquidity and diversification. Then $1,000 into a specialty REIT to get some targeted exposure. Another $1,000 into a crowdfunding fund for those steady distributions. And finally, $1,000 into a ladder of short-term notes for that nice coupon income. See? This mix gives you a little taste of everything. And here's the timeline to make it all happen. In the first 2 weeks, your only job is to open and fund the accounts. That's it. Then, by the end of the first month, you make your initial investments. In month 2, you just watch and track your cash flow. And by month 3, you set everything up to automate and reinvest. It's a really simple, totally achievable process. So, the crucial point here isn't just that you can start with $5,000, it's that you absolutely should. Using these small dollars helps you build not just a portfolio, but something even more important, the invaluable experience you're going to need for your next bigger move in real estate. So the question isn't if you can start, it's when are you going to start?
Subscribe for more insights.